Hi there, and welcome to my YouTube channel. My name is Paulo, and today I want to talk a little bit about private equity in Africa. Right, this is a big subject today as we are seeing private equity literally in the US and worldwide taking so much of the capital markets today that people are starting to rethink about this place that historically people didn't really pay attention to, right? Some of the largest uh, money managers in the world today are private equity firms, right? So I don't want to focus on the US or Europe, but let me give you just some data on the private equity space. So in the US, as of 2021, there was more than 1.2 trillion in deals completed in the private market space, right? That just to tell you how much size that is in, and just to give you a perspective, the US GDP by the end of 2021 was roughly around 24 trillion US dollars, right? So that's a significant size. In Europe, in Asia Pacific, private equity deals accounted for in Europe around 600 billion euros. In Asia Pacific, in dollar figures, it was a little north of 500 billion US dollar. So we are continuing to see a huge, a significant influx of capital across the world in private equity. Globally, it's estimated that roughly 3.4 trillion being managed by private equity firms, right? But when we take a step back and think about Africa, actually, private equity is not a big space yet, right? In Africa, for example, at the end of 2021, private equity had closed deals less than 1 billion in value, and African private equity firms have a little less than 5 billion US dollars. So it's a tiny portion of the market or the space. And the obvious question is, why are we not attracting enough private equity money? And before I answer that, let me actually show you the model that private equity firms operate. Okay, so imagine this is a private equity fund. Okay, or usually managed by the GP, not usually always. And then you have your LPs here who put their hard earned dollars, right? They contribute their dollars to the fund, and the fund goes to buy, companies to hold as part of their portfolio, if that's the strategy they are pursuing, right? So companies in the portfolio and then after a holding period, most of the firms have a 5 to 7 years holding periods, and then they will sell, right, and exit, sell the companies for an exit to be distributed between GPs and LPs respectively. In the US, most exit or sell were at 12.3 EBITDA times EBITDA. If you don't know what EBITDA is, that's earnings before interest, tax, depreciation, and amortization. This is in the US. In Europe, was around 11 times EBITDA. So this is to show you a little bit the type of return these companies are having. So significant achievements there, right? The average returns across the board, depending on the asset side, asset side type, excuse me, can vary between 20 to 50% year over year, really, in some of these firms. So incredible achievements is being accomplished using this model. Now, going back to the initial question is, why aren't people deploying capital in the LP model in Africa, right? So we have to think about what usually happens in Africa. In Africa, if you are a little bit familiar with either northern or the sub-Saharan Africa, you'll know that most money or a significant amount of money that goes to the continent is from people like me who are part of the diaspora who send remittances, right, for daily needs of our relatives, right, to our relatives and family. And then you have foreign governments or international organizations who send foreign aid to the continent, right? And then you see some people who are bold enough to enter the African investment, the African market through foreign direct investment, right? To African market. So and these combine, for example, in 2021, Africans sent roughly 49 billion. Those are the estimates to their remittances, but this money is not really allocated to create new businesses or support infrastructure construction. It's really for things like my relative was sick and that money was used for it, or to pay someone's college and so forth. So and those are some of the way money flows into the Africa. And private equity is a new phenomena to the continent, right? In the US, it's been around since the late 70s or early 80s, if I'm not incorrect about these, right? So and these markets just continue to grow really this way, right? So much cash and money have entered this space that is insane now. But again, why is it that in the African continent we're not seeing so much cash, so much capital being deployed? And here some of the things that I believe based on my observation and understanding of several countries and their landscape are the key driver for these issues. Okay, let's forget the political instability, let's forget the macroeconomic realities and so forth. Every country have problems, right? We've seen people investing, starting private equity firms in complete dictatorship, and they've done well. So let's not use that as an excuse for, hey, African countries are not democratic or African economies are crazy, inflations and so forth. Okay, let's forget that. But here's what I believe are actually the major driver for private equity money to be significantly lower. Number one is the number of targets that private equity firms can buy, right? Remember that model. Private equity usually wants to buy out companies and use that to acquire them. In the African market, right, you have a large informal sector, right? It's not really feasible for acquisition. So number one, that's a problem. Number two, a lot of formal businesses are state owned, right? State owned. Although recently we've seen a major influx into the market, governments selling their assets and stakes and interest in enterprises and companies they control. So government state owned are still very prevalent in the continent. So that's another problem. Number two is, I just mentioned it, is the ability to use debt to finance acquisition, right? So a lot of PE deals would be structured, maybe 20 to 40% equity, and then 60 to 80% debt, right? So if you can't raise debt, right, there is very little incentive to go and find companies to buy, because the idea behind cost of capital. And number three, very similar to what I just mentioned, right? That, right? The interest rate, right? It's absurd. Right now, if I try to go to Angola to borrow money, I'm probably gonna run away from the banks because just imagine inflate, a lot of banks are charging north of 20% interest rate. That's insane. Like, how am I gonna be even able to make profit with a 20% interest rate? The market must deliver superior returns. So I'm not saying that it's impossible, but I'm saying, private equity models, as we know of, may not be feasible to the reality of many places, if not most of the continent, for these factors. I'm not finished yet. So, this is number three. Number four, if you think about how private equity operate and exist, right, you're thinking about the limited number of companies you can acquire. Just think about in the US, if I want to buy a company, it's not so hard. There is estimated more than 30 million baby boomers seeking to retire in the next 10 years. That's a large base of the market that already own businesses who are looking to retire, that I can just be ready to make my acquisitions. And the ability to raise capital is relatively cheaper in the US and many European markets, right? So the other issue is around how much I can rely on the books of these companies, even state government companies, right? The books, I have an accounting background, and it's insane even here in the US the type of things I see when I review the financial statements of certain companies. So the books are really unreliable in many places, unreliable, right? So we need to find a way to address these unreliable, whatever it's spelled, right? It's really complicated. And then, similar to unreliable books is, how do you determine valuation when you have unreliable books, right? You can't really know for sure, but of course, we Africans and professionals in the industry have come up with approaches to actually figure out valuation. But if you're not familiar with the market, and you want to enter in private equity in Africa, this probably is gonna scare you off, because you can't for certain determine the value of companies, excuse me, right? So this is another major issue that a lot of potential founders might encounter. And the other problem here is exit opportunity. A lot of private equity firms are set up with you know maturation date, right, so they are thinking about 5 to 7 years horizon, right? This doesn't work. Africa is not a place where you want to make a quick buck, right? The same way people who invested in place like China, right, they went there for a long run. They entered in the 80s, the 90s. They stayed in the, literally built from scratch and stayed in the market. And now they're starting to do some form of exit, IPOs, buyouts from other private equity firms, and so forth. And because of all these challenges in the continent, right, I believe there should be an alternative that could mirror a private equity fund in many ways, right? And I came up with this model. Probably some other bright people out there might be thinking something similar. But here's what I want to share with you about what I believe could be an alternative to the African private equity landscape. So the African private equity landscape should be something like this, what I consider the PECO model, private equity company operator, right? So the idea behind this is not to focus so much so on buyout, but actually on launching ventures, scaling them without a foreseeable future, as we say in Portuguese, ponto final. Like, that's it. You launch a firm, you grow it, you hold it without any intention of exiting in the near or foreseeable future, right? So how does this model actually do work, right? I want to emphasize this. I believe that, and this is entirely my personal views, They might have flaws, but I really strongly believe that this model would make sense for the African market, right? I want to be able to do an in-depth market study before even putting 1 cent, $1 into any potential investment, even before, setting up the fund itself. You gotta be able to understand the market, right? And number two, I want to be able to find a replicable business model, because that's, where the exponential growth and return will come from. If you are going to enter into an African market, right? A lot of people think of African markets as individual isolated market, like I'm investing in Ghana, I'm investing in Angola, South Africa. No, forget that. Africa is a vast continent with so much opportunity, right? We don't think about the US in terms of, of course, it makes sense to geographically to think about it this way, but here's what I want you to understand about the African market. You have to look into the continent as, a market with more than 300 million of emerging middle class that are ready to use the conveniences and life pleasures, or whatever commodities or goods and services that people in Western world today use, right? There is a large market there. So you want to make sure you're using a replicable business model that would fit your launch due diligence, right? I would stress this: each fund have to have its own launch due diligence, because this model is slightly different to the traditional private equity model, right? And the other factor that I want to emphasize here, they are strategic priorities that I believe would make a major defining element into the success or failure of private equity in the continent. When you launch the firm, you have to be willing to develop your human capital, right? Human capital development, you have to be interested in rapid growth to achieve economies of scale and cash flow stability, because this is what's going to give you the ability to actually grow and move really fast. And number three, you must be willing to build systems and processes to support that growth. And that's it, right? And again, I will say investing in Africa is a long-term game. It's not a short-term game, and it should not be looked as such. So hold your positions as permanent long-term position if needed, right? So that's the way that I see the PECO model working, private equity company operator model, right? So for what industry makes sense for this model, right? I personally believe that, what are considered high impact social venture in emerging markets are actually the space where this model makes sense. Industries like education, healthcare, agriculture, technology, affordable housing, entertainment, because those are traditionally, right, traditionally defensive industry. No matter how the economy moves, people will still need to get education, healthcare, will need food, will need some level of technological tools like cell phones, or apps and so forth, and housing, right, to continue meeting their needs. And entertainment is a little bit for people who can spare affordable income as well as technology. So these make sense. Now here's some of the criteria that I believe when you start doing your market research, right, you need to keep in mind as you are thinking about your fund even before starting to reach out to investors, right? So you need to be to be thinking about, industries with no clear leading players. So gas gas and oil is probably a no, because most countries with gas as commodity, they already have major deals and contracts with companies like ExxonMobil, Total, BP, and other large, Western oil company, and now Chinese companies and Indian oil companies entering the market. So it's not a good idea to go tete-a-tete against these companies. So find an industry with no clear player, right? In Angola right now, for example, education is one of those. Healthcare is one of those, right? There are people who build their own infrastructure and start, for example, a college, a university, right? Because they don't have the reputation nationwide or internationally. If anyone enters the market and builds a brand that is relatively comparable to studying overseas, right, you are going to be able to position yourself in a way that you could become a leading player in that market, if you understand, right? Try figuring areas or industries with potential for high margins, right? Industries with high significant capex may not be ideal. So, industries with low regulatory environments, right, are preferable than industry with high regulatory and compliance requirements. So one thing that I want to point out is try to find industries where you have expertise and you can relatively build a defensive market position, right? Agriculture is one of these. It's one of the sectors that historically across the continent has been underinvested, underserved. So players who are really interested in getting into agriculture, let's say from farming to food processing and distribution, there is so much opportunity there that can be untapped and taken, right? So those who are willing to enter this space, work with government, find ways to produce food at large scale and get potentially a lot of tax breaks here and there, they can use that instead of subsidy as a tool for their investment position. And again, I will reinforce the fact that the founders must have experience, relevant experience and expertise in areas they want to set up their PECO fund, right? It's standard, it's similar to the US. So, or if you don't have experience or expertise, areas that is relatively easy and rapid to build intelligence, expertise, and so forth, right? So once you have done all that, right, you're comfortable. Hey, I have identified, for example, in my case, right, let's say an example, I think Angola is a great market to enter, and I'm really interested in healthcare, just as an example, right? And healthcare, of course, is vast, right? You can think about general medicine. You can think about specialized medicine, surgery, urgent care, or whatever that you want to invest in, right? And do an in-depth study. Oh, I wasn't sharing my screen, right? So Angola here, my country, my industry of choice, healthcare, and one specific sector, maybe general healthcare. Do an in-depth study, understand the trends, the dynamic. Maybe it's not a good idea, so you might end up scratching that. Maybe go into education, right? So you might consider maybe primary school, maybe secondary school, maybe higher education, right? Higher education. So, once I identify maybe I want to be in higher education, I want to build a university, a university campus that rival, let's say, Western institution of higher education, then I will go to set up my PECO fund, right? My PECO fund to bring in investors and so forth. So this is a little bit of the idea behind the PECO model. So we want to be able to, look into Africa, not necessarily maybe in the lens of, Europeans or Americans or Chinese, whoever they are, but to look into Africa from the perspective of Africans, right? And see what matters, what makes a difference there, and is there opportunity? Are there gaps? Are there spaces, gaps we can fill, unmet needs we can be able to come in and invest and make money, right? So I believe, this is, I'm gonna be posting this a report on my PECO fund model, and I look forward to getting your feedback, your comments, and I'm open to see what can happen with this strategy. So thank you for spending time with me here. I know it was a little bit a longer video, but I look forward for your comments and feedback and connecting with you and learning with you especially. So thank you.